This is Nightly Business Report with Bill Griffith and Sue Herrera.
Retail gloom, low unemployment, and strong consumer confidence was supposed to get consumers into the stores, but not every retailer got their holiday wish.
Profit warning. The world's largest airline says profits will not be as strong as expected, raising the stakes for corporate America's upcoming earnings season.
Shifting gears, the new Ford Explorer is sleeker and high-tech. But can the iconic SUV generate big sales for the automaker under pressure? Those stories and much more tonight on Nightly Business Report for Thursday, January 10th.
And we do bid you good evening, everybody, and welcome. Well, it was another positive day on Wall Street today. In fact, the S&P 500 posted its first 5-day win streak since September. We'll have more on that in a moment. But we begin tonight with retail, which was not positive. In fact, it was more like a retail wreck. Expectations were very high for a good holiday shopping season, and in fact, we learned today that it was. But it turns out not all retailers benefited from rising consumer confidence and strong spending. That was the case with Macy's, which surprised investors today with downbeat holiday results. The lackluster performance prompted the company to cut its outlook for profits, sales, and gross margins, and that knocked the wind out of the stock, sending it down 17% today, its worst one-day performance ever. Courtney Reagan starts us off tonight from Indianapolis.
A disappointing holiday sales report from Macy's is the Grinch that stole Christmas from other retailers today. Macy's comparable sales in November and December grew more than 1%, with a double-digit sales increase online. But that was below what the department store expected. Macy's CEO Jeff Gannett said the Black Friday weekend was strong. Sales weakened in mid-December and didn't return to expected patterns until the week of Christmas. Sales were weak in women's sportswear, cosmetics, fashion jewelry, and watches. There was a fire at a distribution center, and a sales event didn't go as planned. As a result, the retailer lowered its earnings, sales, and margin forecast for the year. While Macy's has reported 4 straight quarters of same-store sales growth, investors are starting to wonder if that trend is at risk. Today, the stock is plunging, marking its worst day ever. Macy's shares had grown 80% from Thanksgiving 2017 to Thanksgiving 2018.
Macy's being on mall, Macy's being an apparel retailer, those are tough structural places to be. And that is a little bit different from the Kohl's story, which has done a great job in active, and Target, which has done great with toys, home, baby.
Like Macy's, Kohl's holiday sales improved more than 1% with double-digit growth online. But unlike Macy's, Kohl's raised the lower end of its full-year earnings forecast. Target so far reporting the strongest holiday results, with comp sales up almost 6%, thanks to strong shopper traffic. Toys, baby, and seasonal gifts were Target's strongest categories during the holidays. Target is holding its previous earnings forecast steady. The good news is, analysts say the U.S. consumer is healthy.
The consumer is fine. They're all working. Their wages are going up. They're fine. The problem is the cost structure in retailing is dramatically going up.
E-commerce businesses are currently more expensive to run for retailers that began as physical stores, making online sales less profitable than sales in brick-and-mortar locations.
It's a higher cost of doing business today than what it was in the past. For every one of these companies, margin flow-through is going to be the theme of 2019 in the face of what continues to be a strong consumer.
While MasterCard says holiday sales grew 5% overall, the strongest in 6 years, not every retailer had the jolliest holiday. For Nightly Business Report, I'm Courtney Reagan in Indianapolis, Indiana.
American Airlines caused some turbulence in that sector today. The world's largest airline trimmed its profit guidance for 2018 and said that revenue didn't rise as much as expected at the end of last year. That sent the stock down 4% in today's session. The warning rippled through to other carriers on concerns that they may report similar lackluster results, threatening a record stretch of profitability for that industry.
So with the fresh round of profit warnings, American Airlines, what can we expect as fourth quarter earnings season gets underway next week? Joining us tonight, Lindsay Bell. She's investment strategist at CFRA Research. Lindsay, always good to see you. Happy New Year.
Happy New Year.
You know, what they report for the fourth quarter, I think you agree, won't be as important as what they say they're expecting for the first quarter, right?
Absolutely. It's always about guidance when it's earnings season. And the fourth quarter is actually probably going to be a really good one. We're going to get another double-digit quarter of earnings growth. Of course, that'll be a deceleration from 3 quarters of over 20% growth for the S&P 500, but still very good by historical standards. But looking out to the future, that's where the big question mark is. You highlighted the 2 companies that cut guidance today. We've heard from companies like Apple, FedEx, and several others already warned that earnings are going to be worse than expected.
Right.
Samsung, LG are another 2 companies, and these cuts were pretty substantial, by the way.
So what areas do you have the most concern or worry about? Where are the most vulnerable areas?
Well, I would say I'm most worried about the industrials and the financials, because when I look at those 2 sectors, they've been leading year to date so far. I know it's only been a couple days, but the stocks have been doing really well. But their earnings numbers have not budged much for 2019. The overall S&P 500 earnings growth rate for 2019 has been reduced to 6.1% from 10% earlier in the year. But these 2 sectors, their numbers haven't moved lower. And if you think about what we've heard from FedEx and Apple, especially on the global front with regards to trade, with regards to the slowdown that we're seeing in China, the industrial sector is going to be one that's really at risk.
So the tariff tiff, when it began last year, we had been told that maybe we won't see an impact on the economy until the first quarter of this year. Is that what we're going to start to hear about? Is that what you're expecting?
Yeah, exactly. And I think that you started to see some of the China data in the last couple months come in much weaker than expected. You see the government over there trying to add stimulus to the economy to smooth things out. But I think you're going to hear companies talk about how they're seeing the impact now, as the year ended and going into the first quarter. And you can't forget that while we got some good news on the trade front earlier this week, the situation still hasn't been resolved. And there's that March 1st deadline that can get pushed out potentially. Otherwise, tariffs could go up at that point in time. There's a lot of uncertainties. If you're in the executive C-suite, you have a lot of concerns with forecasting going into this first quarter period. So you have every incentive to be conservative.
So are your thoughts predicated on the economy continuing with the growth that we saw in 2018? Or is it predicated on 2019 being a little slower?
It's predicated on 2019 being a little slower. We're starting to see expectations. Several economists are expecting growth to slow in 2019 from 2018 here in the U.S., but also you're already seeing early signs in Europe, slowdown in Germany, and the Brexit issue is hurting the U.K. China, emerging markets are seeing a slowdown too. So all of that accumulated will impact the U.S. You got to remember, almost 50% of S&P 500 sales come from overseas, so that has a very big impact.
As always, Lindsay Bell from CFRA Research, we appreciate your coming by. Thanks for joining us tonight.
Thank you.
Concerns over earnings were not enough to pressure the broader market today, sending the Dow and the S&P 500 to their 5th straight day of gains. Industrial stocks and the real estate sector helped lift the market overall as investors focused on comments from Fed Chair Jerome Powell. More on that later in our program. But first, the closing numbers. The Dow Jones Industrial Average climbed 122 points to 24,001. The Nasdaq added 28, and the S&P 500 rose 11. And as investors question where this market is headed, a top investor who beat the market for years said today in an interview that the bull market could last another decade.
There are plenty of opportunities today. That's what I'm looking at. In terms of different asset classes doing well, my belief is that we're, in a secular bull market. In retrospect, I didn't know it at the time. It started in 2009. And if I had to guess, we're halfway through it, driven by good economic growth and low inflation.
You think we're halfway through it?
Secular. 10 years in, 10 years to go. I don't know. That's my guess.
However, as you know, the market is still facing some major obstacles like trade tariffs and slowing growth, especially when it comes to China. Eunice Yoon has that part of the story for us tonight from Beijing.
The
The Commerce Ministry was generally positive about the trade talks. The ministry issued a statement saying that the two sides conducted in-depth and detailed exchanges and laid the foundation for resolving mutual concerns. At a regular press briefing, the ministry spokesperson said that the one-day extension also showed that the talks were serious. Now, in these trade negotiations, a lot of focus has been on how to get Beijing to make good on its promises. One big complaint in the business community here has been that Beijing doesn't stick to the spirit of an agreement. The USTR expressed that in its statement after the talks, saying, any agreement should provide for complete implementation subject to ongoing verification and effective enforcement. Well, the Commerce Ministry pushed back on that today, saying China thinks a mechanism is important too, and both parties have an obligation to keep their promises. The comment shows that China doesn't particularly trust that the U.S. will hold up to its end of the bargain either. Amid all this talk, new data out of China show that the economy here is slowing at a faster pace than expected. Both CPI and PPI missed consensus. Consumer prices dropped to a 6-month low. Producer prices fell to their lowest point in 2 years. Nomura called the pace of the slowdown worrying. This is an economy carrying a tremendous amount of debt, and economists are now talking about China entering a deflationary cycle that makes the debt more burdensome than it already is. The Trump administration already believes that it has the upper hand in these trade negotiations, so this latest data will likely only encourage the policy team that it has more leverage in the trade talks. For Nightly Business Report, I'm Eunice Yoon in Beijing.
There were reports that President Trump was planning on talking about trade with Chinese officials on the sidelines of the World Economic Forum in Switzerland later this month. But today, the president tweeted that he won't be going to the gathering of world and business leaders, and he cited the partial government shutdown and his standoff with Democrats over border wall funding.
So far, the partial government shutdown has had only a minor impact on the economy. But today, economists at Bank of America Merrill Lynch said that it's starting to sting. They shaved their fourth quarter earnings growth forecast and then said that first quarter growth estimates could also be trimmed if the shutdown continues much longer. And right now, as Ylan Mui reports, there is still no end in sight.
No paycheck, no peace. No paycheck, no peace.
Federal workers made their frustration with Washington crystal clear today. In protests and rallies across the country, they demanded an end to the government shutdown as they are set to miss their first paychecks tomorrow.
How long do you think our people can afford to come to work? You know, we're required to come to work. We have to pay the babysitter. We have to pay for gas in the car.
It could be quite a while before government workers see money in the bank. Shutdown talks are stalled in Washington, and Democrats say they no longer trust the president's word.
The president just keeps upping the ante. In fact, I said to him, you're moving the goalposts so many times, they're out of the stadium.
Today, President Trump took his case for a border wall down to Texas, amid what he says is a humanitarian crisis of illegal immigration. The trip is fueling speculation that the president will declare a national emergency and build the wall without congressional approval.
I have the absolute right to declare a national emergency. I haven't done it yet. I may do it. If this doesn't work out, probably I will do it. I would almost say definitely.
Some lawmakers here on Capitol Hill have been looking for another way out. So far, they haven't found one. And that means this shutdown could be the longest in our nation's history. For Nightly Business Report, I'm Ylan Mui in Washington.
It is time to take a look at some of today's upgrades and downgrades. Boeing was upgraded to overweight from equal weight at Morgan Stanley. The analyst says strong airline sales could lift the stock by 30%. The price target is $450. Shares rose 2.5% to $352.61. That same analyst at Morgan Stanley downgraded Lockheed Martin to equal weight from overweight. The analyst cited headwinds related to its pension program, which he says will be difficult for that company to fully offset. The price target is $300. The stock was up 2.5% to $277.50.
Twitter was upgraded to buy from underperform at Bank of America Merrill Lynch. The analyst cited increased usage by younger people and more engagement by its current users. Price target $39. The shares gained about 2% today to $33.09. Sticking with social media, Snap was upgraded to market perform from underperform at Cowen. The analyst cited that stock's valuation after last year's plunge. Price target $6. Nonetheless, shares fell a fraction today to $6.22.
Still ahead, Fed Speak, what the head of the central bank said today that left some investors scratching their heads.
A new survey points to a growing risk of recession here in the U.S. According to the Wall Street Journal, economists who were surveyed pointed to a number of concerns, including the usuals, trade tensions with China and rising interest rates. On average, economists surveyed said that there's a 25% chance of a recession in the next year, which is the highest percentage since 2011.
Today, the chair of the Federal Reserve says he does not see a recession this year. Speaking in Washington, he repeated what he told investors last week, that the central bank will be patient when it comes to raising interest rates. But he also said something else that caught our attention. Here's Steve Leisman.
In his third public appearance in the past month, Fed Chairman Jerome Powell sat down for a chat with private equity mogul David Rubenstein and tried to ease market concern over the rate outlook. Powell suggested the Fed is in no hurry to raise interest rates.
I think we're actually in a good place. I think where that leaves us, particularly with inflation low and under control, is we have the ability to be patient and watch patiently and carefully as we see the economy evolve.
The Fed chairman repeated that he sees the U.S. economy as strong and expects momentum from 2018 to carry over into 2019. His biggest concerns, weaker global growth, trade tensions, and an extended government shutdown. But markets sold off during Powell's comments, though several factors were in play, including a soft 30-year bond auction and a tweet from President Trump announcing he would not be going to the Davos World Economic Forum this year because of the shutdown. But some pointed to Powell's comments saying the balance sheet will be substantially smaller than it is now.
We wanted to have the balance sheet return to a more normal level, which is a level no larger than it needs to be for us to conduct monetary policy. Don't know the exact level. That will depend on really the public's appetite for our liabilities, specifically currency. To us, that's a liability, and the public has a large appetite for currency, and also reserves and other liabilities. So it'll be substantially smaller than it is now.
Investors are watching what the Fed does with its balance sheet because of its potential to raise interest rates. The average market expectation is for the balance sheet to decline to around $3.5 trillion from the current level of $4 trillion. Investors, though, will have to wait until the next public appearance or press conference by Powell to find out what substantially smaller means. For Nightly Business Report, I'm Steve Leisman.
Meanwhile, Democratic House leaders and Independent Senator Bernie Sanders today unveiled a plan to cut prescription drug prices. They proposed legislation that would open up generic competition to brand name drugs. It would allow Medicare to negotiate with drug makers and give consumers the ability to import cheaper treatments from Canada. Already, a lobbying group that represents drug makers came out against the bill, saying it would wreak havoc on the U.S. healthcare system by curbing innovation and making treatments unsafe.
An activist investor is reportedly making a bet on MGM. That's where we begin tonight's market focus. According to Reuters, Starboard Value is building a stake in the resort and casino operator. The size of the stake is unclear, but the report says Starboard plans to push for changes at the company. Last week, MGM announced a cost-cutting strategy. MGM shares rose more than 1% to $28 even. Barnes & Noble is warning about the future. The bookseller said it could cut earnings guidance as much as 10% due to higher spending on advertising and promotional activity. But there was some good news. Holiday sales were up 4%, and according to the company, that's the best in several years. Nonetheless, the shares plunged nearly 16% to $6.36. And MongoDB has some new competition. This after Amazon launched a new cloud-based data software. But MongoDB says the new service has shortcomings, and it plans to raise awareness of its brand. Shares were off 13% to $75.20.
L Brands reported a decline in sales, joining other retailers that had a slow holiday season. Profit margins at its Victoria's Secret stores were down significantly, but it wasn't all bad news. The company does expect fourth quarter earnings to be on the higher end of its earlier forecast. But it wasn't enough, though, to send the stock higher. Shares fell 4% today to $26.99. And investors had their first chance today to react to last night's quarterly results from WD-40. The household products manufacturer delivered earnings in line with expectations, helped by strong sales of its signature WD-40 spray lubricant. However, the CEO did say that there may be future volatility in its sales levels due to the timing of various promotional programs. Sales fell nearly 7% today to $171.04. And BlackRock reportedly plans to cut about 3% of its workforce in the coming weeks. That would work out to about 500 workers. The world's largest asset manager said that it's reinvesting in businesses where it sees growth, like technology, retirement, and non-traditional alternative investments. BlackRock shares were down just a fraction today to $399.50.
The chairman of Sears late yesterday submitted a revised takeover bid of more than $5 billion for that retailer. Eddie Lampert, who is also Sears' majority shareholder, sweetened his offer in order to win approval from a federal bankruptcy court. Lampert's hedge fund will take on about $660 million in additional liabilities in an effort to strengthen its proposal before a Monday bankruptcy auction. The hedge fund said that the plan will, quote, provide more value to stakeholders than any other option, in particular, a liquidation.
Coming up, one of the most popular vehicles on the road is getting a makeover.
It is the first all-new redesign of the Ford Explorer in 8 years. But is it enough to hold off the competition? I'm Phil LeBeau. That story coming up on Nightly Business Report.
Some positive news for the housing market. Mortgage rates have fallen to a 9-month low. According to Freddie Mac, the average rate on the benchmark 30-year fixed-rate mortgage dropped to 4.45% last week. That was the 6th straight week of declines, but it is also still higher compared to last year. The drop has prompted a rise in mortgage applications and in refinancings, but as we've been reporting, the partial government shutdown could keep some of those applications from closing.
Fiat Chrysler will pay about $800 million in fines and costs to settle allegations that it used what's called a defeat device to pass emissions tests. The Justice Department sued the automaker in 2017, claiming illegal software was installed on Cherokees and Ram pickups to evade pollution controls. Fiat Chrysler says the resolution will help maintain customer trust.
Tesla said today it's going to stop selling the least expensive versions of its Model S and Model X vehicles. Orders will end on Monday for both of those. Customers will still be able to purchase the higher-end versions, though, which come at a higher price point, upwards of $90,000. Tesla did not say why the lower-priced models are being discontinued, but experts are guessing that it may help the company control costs or reallocate materials and labor.
Britain's biggest car maker is cutting a lot of jobs. Jaguar Land Rover will reduce its global workforce by 4,500 as part of a plan to control costs. That is in addition to the 1,500 that left the automaker last year. The company has been under pressure in markets like China, where sales were soft for the first time in 20 years. Jaguar Land Rover has also suffered from the uncertainty surrounding Brexit.
Ford is cutting thousands of jobs as well as it moves to overhaul its global business. The automaker said today it's going to close plants in Europe and end production of some low-profit models. Ford says that the restructuring will cost about $11 billion, and it will take between 3 and 5 years to reshape its overseas business.
And Ford also sells America's top midsize SUV. And now the Ford Explorer is getting a makeover. The automaker is rolling out the first all-new model in 8 years as Ford pushes to rebuild sales that have been under pressure. Phil LeBeau has the story from Detroit.
On a big stage taking up a third of a football field, Ford rolled out an all-new version of its biggest-selling SUV, the Explorer. Sleeker and packed with the latest technology, the new Explorer hits showrooms during the busy summer sales season.
This is a pace car for a whole new utility lineup, Phil. So this is really important not only for our brand, but for our business.
Ford's business is under pressure. It's downsizing in Europe, rebuilding in China, and investing heavily in autonomous vehicles that may not pay off for years. All reasons Ford needs a new Explorer to generate strong sales. The Explorer may be the best-selling midsize SUV in the U.S., but the competition is becoming more intense, with a wave of new models rolling into showrooms over the next 3 years.
You've got another 6 models or so coming into the market this year and into next year. It's going to be tougher for each of those models, including the Explorer, to maintain their volume and grow.
With gas prices still relatively low and job growth strong, Ford sales should hold up early this year, until the automaker's redesigned Explorer and an all-new Ranger pickup roll into showrooms and bring with them an expected surge in business.
This is when the car business is great. When you have new models, customers are coming in, shopping the brand. It's going to be a lot of fun for Ford.
An iconic model capable of going off-road, trying to smooth out a bumpy period for America's second-largest automaker. Phil LeBeau, Nightly Business Report, Detroit.
Finally, Oracle has entered into a new deal that it hopes will deliver a home run. The company has won the naming rights to San Francisco Giants' waterfront ballpark, which will now be called Oracle Park. During an interview today, Oracle CEO and the head of the Giants called it a perfect partnership.
It's a 20-year partnership with Oracle. I mean, the way we look at it is, look, we are in Silicon Valley. Within a 30, 40-minute drive from here, there are companies changing the world. One of those companies is Oracle, and we're partnered with them for the foreseeable future.
It is estimated the deal is worth somewhere between $300 and $350 million.
That does it for us tonight. Thanks for joining us.
See you tomorrow.